Good afternoon, everyone. Sorry for the slight delay, small technical issues. I hope everyone can hear us properly. Very warm welcome to the investor webinar, basically to share the results that was released yesterday to the Colombo Stock Exchange, 2017 numbers. We had a very good year. Of course, we'll come into details. With me, let me introduce the panel with me. We have Lalit Fernando, who just joined from yesterday as Group CFO. Lalit brings us a wealth of experience. He just joined earlier with Sri Lanka Telecom Group, and prior to that, Dialog and various other Nations Trust Bank and various other financial institutions. Then we have Suendrini, who is Assistant Vice President Finance. Then Bhuwaneka, who is the VP Corporate Banking. We have Sanjay Pera, the Vice President handling the retail network and the branch network, retail bank and branch network. Niran, who is the Vice President Treasury. And also Indika Ranavira, Vice President, SME, Middle Market and Business Banking. In the agenda, we'll first cover the business overview, then the macroeconomic analysis, and then we move on to the more detailed discussion on the financial performance. And then we have question and answer session as usual. So corporate profile and all, I think we have touched upon this many a times. So since we have a lot more to discuss on financials, I will skip this. And so is the group structure. NDB is the only bank with investments in the investment banking, capital market, wealth management clusters. So those details I'm avoiding because that dedicate more time to discuss on the financial numbers. Macroeconomic analysis. Of course, last year the economic growth rate is very moderate. Up to Q3 numbers are out, which is 3.7. Q4 should be slightly better than that. Mainly driven by, actually the reduction is mainly because of the agriculture sector, which got affected by adverse weather conditions twice. But one good thing is the increase in the export earnings. And also the widening of the trade deficit to US dollar 8.5 billion. That's something that we saw in 2017. The rupee depreciated by 1.9% against the US dollar up to in 2017. But in terms of the fiscal sector, we saw some good development, especially on the balance sheet management. Country's reserves improved up to about $7.8 billion. And also in the balance sheet, balance of payment, there was a surplus recorded after many years. So these are some of the positive developments that we saw. Credit to private sector, of course, decelerated up to November. The November number is about 15.4, and the December numbers also central bank discussed recently is just below 15%. So the overall credit to the private sector is around 15%, which is in line with the regulators' expectations at the beginning of 2017. Headline inflation is 7.1% as at December with core inflation at 4.3. Of course, January, the headline inflation has come down to 5.8%. So I think the inflation-wise, is the lowest core inflation, especially 4.3 is the lowest core inflation that has been recorded for the year 2017. In terms of banking sector developments, monetary policy, monetary rates remain unchanged. SDFR at 7.25, no change to the interest rates since March 2017. The total banking sector assets recorded 10.3 trillion. Year on year, the growth in asset book was around 13.8% for 2017. And industry ROE, the banking sector ROE was about 17.6%, slightly lower than what it recorded in 2016. Moving on to the financials, these are financial summary. I think we have improved from all sectors, all 4 sectors, profitability, the balance sheet position, the efficiencies, and also the business capacity. It's quite a good year coming from all, the contribution coming from all sides. Net interest income, we had 27% growth from 8.4 billion to 10.7 billion. Net operating income, again, 26% growth from 11.7 billion to 14.8 billion. Operating expenses, despite the VAT impact and all, despite we increasing the branch network, the operating expenses growth was 14% from 6.4 billion to 7.3 billion. So as a result of all this, the profit after tax improved by 37% from 3.1 billion to 4.35 billion. And class level profit attributed to shareholders at the group level, again 38% improvement from 2.6 billion to 3.7 billion. In terms of the balance sheet, we had 15% growth in the total asset book from 335 billion to 383 billion. These are at the bank level. And the total loans, we had 20% growth, slightly above the industry average, from 228 billion to 274 billion. That's 46 billion growth in lending book. And in terms of deposits, that's where we had the highest growth, 34% growth, or 70 billion rupees over the year, from 204 billion to 273.5 billion. In terms of efficiencies, cost-income ratio, that had a substantial improvement from 49% 2016 to 45.5% by 2017. Net interest margin, this is something that we are working very hard, and you can see quite a substantial improvement from 2.6% to 3% by the improvement, the net interest margin. Return on equity, this is again a ratio that we were working hard to improve on our returns to be on par with the industry. So there again, substantial improvement from 13.3 last year to 16.2 by end of 2017. NPL ratio, that's something that we are really proud of. It has improved from 2.6% in 2016 to 1.83. Even the quantum also has come down, and the ratio also has improved to 1.83, much better than the industry average, which is now around 2.5%. In terms of business capacity, another ratio that we are working hard to improve was the loans to deposit ratio, to have a loan growth supported from our own funds. So that has improved from 115% to 102%. So we are almost there where we are supporting our entire loan book from our deposit portfolio. In terms of capital adequacy, again, improvement from 12.95% to 13.8%. And liquidity ratios, domestic banking unit, again, improved very much above the liquid ratio, about 20%, from 21% to 22%. So I think all in all, we have improved from all sectors in terms of the balance sheet and the P&L side. More details on the income statement. Net interest income, again, as I mentioned, 27% growth. 2.2 billion growth in the net interest income to 10.7 billion. Other income, 16% growth. We'll get into more details later, from 4.6 billion to 5.4. So as a result, total operating income grew from 13.1 billion to 16.1, a 3 billion increase, or in other words, 23% growth. Impairment, actually there's a reduction in impairment. One is, of course, the quality of credit that got improved, plus some recoveries. So altogether, the total impairment from 1.3 billion, it has come down to 1.259 billion, 8% reduction. And operating expenses, the growth, as I mentioned, was 14% to touch 7.3 billion. So as a result, the operating profit before tax, 41% growth in operating profit before tax, where we crossed 7.5 billion compared to 5.3 billion previous year. There's a 48% growth in tax component. So almost 1 billion increase in the tax payments from 2.1 billion to 3.1 billion. So all in all, we ended the year profit after tax 37% growth from 3.1 billion to 4.3 billion. Similarly, at the group level, we had the similar 37% growth. PAT level, it's 2.8 billion to 3.8 billion. This is the profit attributable to the shareholders, the PAT level. So 38% growth in PAT. I would say the most impressive numbers here are, of course, all the numbers are quite good. I think key areas that we are focusing, the interest margin, the 3% interest margin, that's something that we are working hard. And also the loan volumes have helped us to grow our net interest income. That's where the top line growth, 27% growth, which helped us to achieve that goal of getting the net NII. Moving on to more details on the net interest income. As you can see, interest income has grown by 30%, from 28 billion to 37 billion. Interest expenses, similar percentage growth from 31% growth, from 20 billion to 26 billion. So as a result, the net interest income, 27% growth, from 8.4 billion to 10.7. So both net interest income and expenses have grown by similar percentage, 30%. However, the volume contribution, actually the growth in the balance sheet growth has contributed to the improvement in the net interest income. NII, the improvements mainly due to one is the improvement in the net margins, 36 basis point margin, and other thing is the growth in the loans, 46 billion growth, the quantum growth. In terms of deposit, it was 70 billion growth. Actually, these deposits helped us to replace some of the high cost borrowings that we had. Some of the even the foreign currency loans that we prepaid during second half last year, but the deposit growth actually supported to reduce some of the high cost borrowings. So all contributed to the improvement in the net interest income. And the reasons behind the improvement in net interest margins are purely the focus strategies that we implemented, also the repricing of the book, very interactive ALCO sessions we had, and then repricing of our book, and also the balance sheet management, all contributed to the improvement in NIM. Apart from that, strategically, we focus more on the SMEs, retail side, retail products and SME. That also helped us to grow our NIM. This is a revenue analysis of the revenue, especially the non-interest income. Now, there again, we had seen 12% growth in the fee and commission income from 2.2 billion to 2.5 billion. Trading gain was about 8%, where we crossed 1 billion. And gain from the financial investments, quite a substantial gain, but the quantum is about 570 million. Operating income, other operating income, that's 3% growth, 1.2 billion. So total non-interest income, we had 16% growth from 4.6 billion to 5.4. There again, the contributors to the improvement in the fee-based income, mainly coming from retail and SME sector, plus also our focused approach in growing our trade finance book and remittance book, also supported in growing our fee-based income. And you can see from the pie chart, the contributions coming, the net fee and commission income, the segmental contribution. There again, what is in green, the retail and SME sector, the contribution to the fee-based income is 54%. And from the corporate book, the commercial banking side, 33% growth. Analysis of the operating expenses. All in all, 14% growth in operating expenses. This is despite opening 3 new branches. We have added 5 ATMs to the network. Now, all in all, we have 107 branches and 121 ATM serving the clients. Of course, we have also relocated 2 branches. So, in terms of expenditure, it's almost similar to opening new branches. Then, in terms of product launches, we had 4 new products launched during the year, and also one relaunch of an existing product. And in terms of staff headcount, we had 61% additional staff added on to the workforce. So despite all that, and also, of course, we had a VAT increase. Despite all that, the increase in total operating expenses was 14%, from 6.4 billion to 7.3 billion. The personal expenses increase is 5%, and other expenses, that's where the areas that I explained, the additional branch network, and also the marketing related expenses. So all in all, despite the 14% growth in costs, I think the efficiency is really shown in the cost income ratio, which has improved from 49% last year to 45.5%, substantial improvement in the cost income ratio. Actually, it's mainly driven by the increase in the operating income, which is shown in blue, while the operating expenses, growth in operating expenses is lower as a percentage than the growth in operating income. Moving on to the balance sheet. Overall, 15% growth in total assets from 334 billion to 383 billion. Of that, you would see the biggest growth coming from loans, loans and advances, 20% growth of 227 billion to 274 billion. The cash and the investments almost remain same. So actually, what we did was focusing more on interest-bearing loans and advances, trying to grow on that sector. In terms of the liabilities, again, the deposit growth, 34% growth, crossing 273 billion. And there's increase in the shareholder value, equity, from 24 billion to 28.8 billion. So overall, 15% growth in terms of total assets. Group level, we have crossed 388 billion, again 14% growth in group level assets, and group level shareholder equity, now we have reached 33 billion. So 5-year CAGR, the total asset growth is around 18.6% when you compare the last 5 years growth in assets. Going on to more details in the balance sheet. Loans and advances. 20% growth in loans and advances coming from the sectors that are shown in the pie chart. Actually, all areas, corporate, project finance, retail, and SME, all sectors have contributed to this growth. The growth is coming from all sectors. This is basically the concentration. 20% of our book is into commercial banking, 33% into retail and SME, and 22% on the project finance. Loan growth as a percentage, 20% growth. The quantum was 46 billion. And I think since the market growth rate was around 16%, I think we have improved our market share in terms of the loan book. The asset quality, again, good story to share with. Substantial improvement in the NPL ratio to 1.8%. Very much below the industry average of 2.5. The sectorial exposure, again, the pie chart is well spread among various industries. There's no concentration risk. The 25% exposure, that's the largest exposure, is to the manufacturing sector. So the NPL improvement is due to several reasons. One is, the major reason is the sound risk management processes that we have, especially at the loan origination level, and also throughout the year managing the loan book. Very robust, active and proactive account management. Then also in terms of recoveries, again, dedicated and effective recovery process. All those, the combination of all that contributed to improvement in our NPL ratio. Going on to deposits. I would say this is where we are focusing very hard to improve our deposit base so that we have a lending book self-funded, 34% growth in deposits. And this is very much ahead of the industry growth rate in deposits. The industry growth in the deposit rate was around 17.5. So it's 200% growth compared to the industry to reach 34%. Or in terms of quantum, 70 billion growth in deposits. I think this is the highest deposit growth that we have seen over the last 5 to 6 years. In growing that, we managed to preserve the CASA ratio at 21.2. You would have seen the industry CASA ratio reducing. However, we managed to keep the CASA ratio at 21.2. In fact, the figure, the CASA component, has grown by 25%. Or in terms of quantum, it's actually 12 billion. 12 billion growth in CASA base, current and savings account base, which I would say is commendable, especially in a scenario where the interest rates were going up and the consumers moving towards more fixed term arrangements, we have managed to improve our CASA base. Though it's not shown as a percentage, the percentage remain because mainly the growth in the deposit base, 70 billion. The quantum and the CASA quantum was about 12 billion growth. Actually, various areas contributed to preserving the CASA ratio. We launched several savings products and also current account products. For the retail staff did an excellent job moving towards the masses and growing the savings base. So we introduced a ladies savings account, investment planner, several products actually introduced that helped us to improve on the current and savings base. And all these CASA accounts are low-cost deposits. Capital management at group level, the Tier 1 equity ratio is 10.5. At bank level, it's 8.85. Tier 2 total capital ratio is bank level 13.89%. Group level 15.2. These are well above the minimum requirements of 11.25. We are at 13.8%. We have a very strong ICAP framework in place, ensuring healthy capital levels. We always maintain a certain cushion over the minimum level. Of course, in terms of capital enhancing, capital infusion, we need to really work on that, especially latter part of this year, because of the IFRS impact, IFRS 9 impact. Plus, of course, to support our growth plan, we would be tapping the capital markets to grow the capital base. But at the moment, we are quite all right with the capital requirement in terms of minimum capital requirements as well. These are some of the investor ratios. Of course, the price per share, 136%, that doesn't reflect the growth, doesn't reflect the improvements in the financial improvement that we have shown. One is the market is also distressed, but at book value, price to book value of 80%, I would say this is one of the well-rated shares that the investors should consider. Earnings per share has improved from 19 rupees to 25.5 rupees. ROE from 13.3% to 16.2%. Return on asset from 0.99 to 1.21. And price earning times from 8.1 to 5.3. So enhanced ROE now 16.2 is almost in line with the industry average of around 17%. The group ROE that has also improved from 9.2% to 11.7%. So financial basically that's what we have covered. I have two more slides just to share the awards that NDB and the NDB group has won. I think 2017 was a award-studded year for NDB. We have won close to 40 awards and titles by the bank and also group. New awards as well as defending several titles that we have won for consecutive years. All those details are given in that. For overall excellence, we got National Business Excellence Award, Domestic Retail Banking Award. Then on the annual report, again, Chartered Institute, CS Sri Lanka Award. We have been also earmarked for the South Asian region award that we have been advised. In the digital banking space, we won several awards. I think our mobile app has done remarkably well. We have crossed more than 4 billion transactions within the year, both at Lanka Pay, the local awards, as well as international awards. Transaction banking for the dollar clearance both from HSBC and Deutsche Bank. Our transactional banking, especially as a support services, have been recognized for straight-through processing. In terms of investor relations, CFA Sri Lanka Capital Markets Award 2017, we won the Gold Award, and again, thanks to probably contribution from all of you. We continue to have these kind of investor forums that would help us to retain that leadership that we have gained. Global Banking and Finance Review, again, for Best Investor Relations, we have been recognized for 2017. Women Friendly Banking, couple of awards, and even for marketing for the Brand Excellence Awards. HR side, several awards. Islamic Banking, then the Road and Belt Initiative, recognizing our efforts in developing the China-based business, and the NDB Group, NDB IB Euromoney Awards 2017, the Best Investment Bank, several awards that NDB IB has won. Our subsidiary in Bangladesh, NDB Capital, again, they won the Euromoney 2017 award, and Best Investment Bank in Bangladesh award for the third consecutive year. And NDB Securities, they won the CFA Sri Lanka Capital Markets Award for Best Stockbroking Research Team. So like that, several awards. I think these would also motivate us, the staff, to continue to serve the industry, continue to serve the community in the process of growing the bank. So basically that covers the presentation. Now it's time for you all to raise questions, and my team and us, we are prepared to provide whatever the clarifications that you may have. Okay, there are a couple of questions. What is the reason for high growth in gain from financial investments? Niran, you want to take that?
Yeah, it's mainly driven by the capital gains, which resulted in we were exiting from the bond portfolio because there was a price arbitration. So with that, the biggest component was the capital gains in the bills and bonds portfolio.
And there's another question, what is the impact of IFRS 9? If you have done any working on this, and how will it impact the bank? I think the industry is working with several audit firms to work on the numbers. So the estimated figure is between 40% to 55% in terms of increase in the provisions that would have an impact on the balance sheet. In the case of NDB, we are finalizing those numbers, so we will be within those industry averages. We are working closely with our audit firm to work on the numbers. So when we plan our capital raising activities for this year, we have taken into consideration the IFRS 9 impact as well. There's a question also on what would be the impact on debt repayment levy. Do you see it being implemented? Of course, it's too early to comment about it. Industry would be meeting the finance ministry officials during this month to clarify on what basis that to be applied. So it's very difficult, very early for us to comment about it. There's one question, can you please elaborate on the bank's figure, other operating income, 1.24 billion?
The 1.2 billion includes partly the revaluation gains from our foreign currency reserves as well as group dividends. and the same amount of group dividends we have received in the previous year also. So actually the other operating income, the growth is purely coming from banking operations.
IFRS 9, is it going to be implemented from 2018, late 2018?
Yeah. Now the industry, the banking industry wrote to the Institute of Chartered Accountants and also met the central bank, and the Chartered Accountants Institute has given us transitional guidelines where all banks could apply the IFRS 9 impact on the annual financial statements for 31st December 2018. So the industry it's under discussion. So the guidelines are available. So most probably the industry will take a call collectively.
There's one more question. Can you get the individual figures of the gains from revaluation of reserves?
It's approximately around 300 million.
For deposit growth, do you see this continuing in 2018 and forward? I would say yes, because that's we have a liability-driven strategy 2018 onwards. So what we saw was that just the beginning. We would have more focused approach in growing, because coming from a roots of development banking, naturally compared to some of the other commercial banks, our advance to deposit ratio was an area that we wanted to work on, and that really shown in the growth in deposits, 70 billion versus advances 46 billion last year. But we would continue to have that focus in this year, especially through our retail network, growing our current and savings base, plus of course other deposits. But definitely that focus, the momentum would be continued during 2018 and beyond. What is the loan growth you expect next year and in medium term? I think loan growth for this year, we are expecting in line with the regulator expectations as well. So one has to ensure that what is driven from the regulatory framework. But we would say between 15 to 20% kind of a growth rate in the loan book as well. What are the loans classified as other and the reason for high NPLs in that category?
Okay, others represent all consumer facilities, but I mean it is not hardcore NPLs. These are relatively, if you take the composition, it's high, but relatively low compared to the overall loan book.
So this has the leasing portfolio,
personal loans,
the personal loans, little bit of credit cards,
loans,
housing loans. It's a combination of all those industries. So consumer loans, and then the leasing and all. Are you planning on a rights issue this year? If so, around what is the amount planned to be raised? Yes, I think we need to raise capital there. So there is no doubt about our requirement to raise capital, especially in line with our growth plans for the next 3 years. So we had to tap the market. So the rights issue is on the cards. But the amount is too early for us to work on those numbers. Yeah, so we need to consider several aspects. One is the IFRS impact itself, depending on that, and also the growth rate that we have planned, growth plans. So the amount, difficult to quantify it right now, but certainly we need to raise capital in this year. And I'm sure with this kind of ROE, it would not be a challenge to raise capital. I'm sure investors would also favor us in going to the market and having capital raising activities. Okay, there's a question about what led to a 2 billion write-off of individual impairments. Okay.
I think you refer to the notes that are published along with the financial statements. Now, this is the write-off that we made from the closing balance sheet provision. Now, for these, the provisions have been made in the previous years, and we have identified that, we cannot recover. So, those loans have been written off, but there is no impact on the performance for the year 2017. Fully provided.
There is a question, when do you plan to be a DSIB, that is a systemically important financial institution? I think the rate at which we are growing now, our balance sheet is 383 billion. We are looking at either 2019 or 2020 to cross that level. So that's one of our goals as well. What is your outlook on interest rate this year and next year? Niran, you want to elaborate on that?
It looks, we think that it will be very stable this year, especially the first half, and probably even a marginal rate cut is a possibility, provided the headline inflation comes below 6. But otherwise, rates are expected to be very stable during the first 6 months, and also we may see a slight increase again towards the last quarter because of the rupee debt repayments, which are very much lined up in the last 2 quarters.
Okay. There's another small clarification. There is a provision of 41 million at group level. Can you elaborate on this?
These represent some of the provisions that we have made for our investments in subsidiary companies based on their net asset positions. So these are actually not write-offs. These are provisions which will be recovered in the near future.
Of course, there's an interesting question on if you adjust the net profit from the dividends from these group companies, the ROE level comes down to around 13%, which is lower than industry. And there's a question also, how do you plan to improve on this? Yes, actually at bank level, the ROE is improved to 16.2, but at group level, there's some high capital maintained at the group level, almost close to 4 billion. So when you use that as a denominator, the ROE level comes down. But that's the nature of the investment banking business as well. These days, the opportunities for investment banking are a bit low, but we are quite comfortable with all these activities happening. The financial center that is coming up, the government also looking at listing some other SOEs. There are opportunities that we are expecting in coming years, plus the stock market activities. So that would help us, but we are also looking at rationalizing this capital base and trying to improve on the ROE. So several discussions are also taking place to work on this group level improvement into the ROE level. Not add anything. Is there a particular customer segment or business line which you would focus on heading into 2018? I'd say a more focused approach in growing the SME and the retail base. We have quite a good corporate book, similarly project finance book. Whilst growing that sectors, I think we would focus more on growing the retail and SME space, because of our 107 branches, more than 55 of them have been added to this network in the last 5 years. And these are the branches that are getting established in their respective townships. And this is the time that we need to make use of those strength relationships and grow that book. So that is why a more focused approach in growing the retail and SME space. So you can see more focus, more growth coming from those sectors. That would also help us to improve on spreading our risk base and also improve on our margins. How did the bank manage to achieve a strong quarter-to-quarter loan growth in fourth quarter despite the slowdown in the overall industry? What industry sectors do you expect to drive the loan book growth in 2018? So to the second question, I think I answered, but to the first question, quarter-on-quarter growth in the fourth quarter, actually the strategies that we implement, especially focusing on retail and SME side. We were working on this since mid of last year, but the real results came towards the latter part of last year. So there was substantial growth coming from the SME side, plus the retail side, again, the incentivized based sales team. We grew our sales team, sales staff as well. So when they are onboarded, their ability to deliver also high. We continue to invest in this sales force. So those combined effort helped us to grow in our quarter, the last quarter loan book. Are there any sectors that you are cautious about in growing your book in 2018? Sectors? Of course, I think all the sectors are growing quite well. I don't think there's undue worry about certain sector, but I think one sector that we are a bit cautious is on the agriculture side, especially on the paddy processing side, as one of our SME drive, but I think that's some area we would have more cautious approach. Apart from that, Bunak, anything from corporate side?
Because of the erratic weather conditions, plantation sector will be a cautious area that we'll be looking. Cautious. Yeah.
Are there any other questions? Anything else you want to add? Huh? So seems to be, yeah, we don't have any other questions. I think we have covered all. So would like to thank all of you for taking part in the webinar, and also to my team who have been with me. I think we had a tremendous year, judging by the numbers, and the improvement has come from all fronts. The asset side coming from all the sectors of the business, plus the liabilities, and improvements in the NIM, improvements in the NPL, the credit quality, all have shown us that I think the NDB, the potential, that's what we mentioned at the beginning of last year, unlocking our potential to unleash yours. So we have unlocked our potential, and this is what NDB is capable of. We have a tremendous staff, strength, high caliber staff, and the support coming from all the shareholders. So bank has tremendous potential, and during next few years you would see we unleashing these potential and also helping the industry to grow. So thank you very much for being part of this webinar and closely following NDB. I think I'm sure that you can expect a lot more to come on positive side from NDB group going forward. Thank you very much.